this is Mike Mascia of Cadwalader. Thanks for dialing in to Fund Finance Friday Industry Conversations. Relatively uneventful week in fund finance. Deal volume continued on at a relatively healthy clip, but nothing earth-shattering really occurred. With the August 7th deadline approaching for registration under the Cayman Islands Private Funds Law, we're trying to keep everybody informed as we get closer each week. So this week, we've asked Tina Meigh of the Maples Group to join us. She's been doing a lot of work on registrations and directly coordinating with SEMA. Tina, how you doing? Thanks for joining us.
Thanks for having me. It's good to have the opportunity to talk again.
You bet. Are lawyers in the Cayman Islands getting any sleep right now?
A little bit, maybe not the full 8 hours, but we're getting enough.
Yeah, good. Well, one of the questions that was on everybody's mind when the amendment came out the week before last is, so many of these funds have so many AIVs formed under Cayman Islands law, that seems like, at least from the outside looking in, like a huge increase in the number of entities that need to register. What's going on with AIVs and the registration process?
Well, yes. So the law changed. The law changed last month to extend the definition of a private fund, which, as you say, has brought AIVs now into scope, or to a large degree. There are still certain exemptions, the same exemptions that applied before in relation to, there's 25 of them that are scheduled to the law. So single investor funds are typically out. Group entities and those with principals, or employee loan programs, those kind of structures are still out. But in the main, some of the exemptions that previously applied, funds are no longer able to rely on. So that has brought into scope a lot more AIVs within scope of the law, and therefore we're working very hard in order to get them registered by the 7th of August deadline, which has not changed. So notwithstanding that the laws changed the definition, we're still working to meet that same deadline.
So Tina, you've been interfacing with SEMA a lot yourself. Kind of what is your involvement then?
Yes, so we've been working very closely with SEMA because, of course, the registration of all of the private funds, whether that's AIVs or not, is of paramount importance to fund finance industry generally. So it was obviously critical that we made sure that they understood the structures and the contractual obligations that were in place, which thankfully, and of course they do, and that we worked together to make sure that everybody was in compliance with the law to the extent that we had prior contractual deadlines that kicked in before the 7th of August. So we've been working very closely with them, and we being myself, the Maples Group, but also the industry as a whole. And they've been very responsive and very helpful in getting everybody registered that needed to be registered by those prior deadlines. And of course, we're working very hard to meet the 7th of August deadline now for the wider scoped AIVs.
You guys represent a lot of the funds, so I assume you're doing a lot of the registrations. How is the actual process? Is it painless or is it hard? Like, what's the process and what's it like?
Mm-hmm. Yeah, I mean, we're working very closely with a lot of sponsors. The Maples Group has around 55-60% of the market share of those sponsors that are registrable. So yes, we're working very hard with them. The process is, I think as some of the colleagues in the industry discussed last week, it's an online website upload in the same way that you would have mutual fund registration. So it's an upload. We, the Maples Group, have an internal computer program as well. So we upload everything into that, and then the bots get to work and process the larger number of applications. So it's volume work, certainly, and there are a lot to get through. But I think my latest statistic from one of my formation partners that I've been speaking to just this morning confirmed that we have got 98% complete in terms of documentation and confirmation from clients, and now it's a case of getting the paperwork and the information uploaded onto the SEMA system.
Great. And what's your kind of gut instinct around the August 7th deadline? Do you think we'll get 99.9% of the funds registered by then?
Absolutely. Everybody is working incredibly hard to meet that deadline and hopefully beat it in most cases. And certainly in the cases with the larger sponsors as well, a lot of the information that is having to be provided to the monetary authority is actually very similar across all of the fund groups. For example, the identity of AML officers and that kind of thing. So actually that information we already have, the sponsors are readily available. It's just a case of documenting it and getting it uploaded onto the system. So I don't have any concerns with the 7th of August deadline, albeit that it's going to be, everyone's going to be working incredibly hard and are probably going to be looking to take the 8th off.
Any additional amendments forthcoming that are going to scope in more entities to give you more work?
I don't think so at the moment. I mean, the 25 exemptions that we have, I mean, they attach to, you know, your structured vehicles, your securitization vehicles, and generally sort of non-fund arrangements, as you would absolutely expect. So this is the regulation that we're expecting. This is the regulation that, you know, we as an industry support. It's gonna help us and further our reputation as a jurisdiction. So from that perspective, it's actually all very positive, despite the fact that we have some deadlines that we have to meet in the interim. But it's a good step for the jurisdiction, and hopefully once this is done, then it will be absolutely business as usual.
Great. Well, I'm sure there'll be a party in the Caymans on August 8th. I wish I could fly down there to join you guys.
Yeah, well, apparently the borders are opening in September, so maybe 1st of September you can do that.
Sounds good. Sounds good. Thanks for the update, Tina. It's good to see you.
You're very welcome. Nice to speak.
So next we have with us Mike Breaux, who leads Steifel Bank's Fund Finance Group. Mike, how you doing?
Doing great, Mike. How are you?
Yeah, doing well. Thanks for joining us. It's good to have another North Carolinian on the.
Yeah. Things are great down here in Durham. Just working from home. Trying to get out of the house when I can, do some socially distant activities, a little bit of hiking, kayaking, mountain biking. So I can't complain.
Awesome.
How are you?
Awesome. Yeah, doing great. So it's funny you mentioned kayaking. Check out this picture of this fish I caught from my kayak. I was down in Hilton Head last weekend.
Nice.
Yeah, good. Well, it's been a little bit over a year now since you joined Steifel. How are things going?
Yeah, no, things are going great. About a year and a half. First week at Steifel was actually during the 2019 Miami conference. So it was a little bit of a hectic time, but fast forward to today, and it's been a great ride. Haven't looked back. We built a great portfolio and got a lot of momentum going up here into the second half of the year. So it's been great. And as far as kind of where Steifel fits in the overall market, I'd classify us as not so much of a market share play necessarily, but more of a controlled volume, kind of relationship focused, high touch bank, especially for clients that share a lot of strategic value and synergies across the organization. So, but yeah, it's been great.
Good. Well, tell us a little bit about your practice and what segment of the sponsor market you guys focus on.
Yeah, so a little bit of background. So Steifel's been around for a really long time, and they've developed, various sponsor-facing business units over time. So, we have a great placement agent with Eaton Partners. We have various investment banking teams focusing on different sectors, doing M&A for various sponsors, a lot of lower middle market buyout funds, a lot of growth, a lot of venture, various direct lending groups in Steifel Bank. So there was already this kind of web of sponsor relationships, a lot of interaction there. Why not bank these sponsors at the fund level as well? So it really seemed like a natural fit. So that's exactly what we did. We added fund banking. That's not only lending at the fund level, that's all the kind of treasury management, deposit accounts, and kind of everything tied up with the bow. So, it's been great.
Good. And what type of deals are you focused on?
So 90% of our book are sublines. We're fairly asset agnostic. So, we're going to bank funds of all different asset classes. As I mentioned previously, our market tends to gravitate towards that lower middle market buyout and venture, but, we have a lot of real estate funds as well. So, our typical subline is going to feel like a pretty straight down the middle, simple blanket advance rate subline, maybe with some NAV-based step-ups. We do a lot of partially uncommitted lines, and we usually land at a bilateral deal somewhere kind of sub 200 million. So that puts us in the position to comfortably service funds 1 billion and below, sometimes 1.5 billion and below, really depending on how much they borrow. And that's a really comfortable space for us. That's, again, a space where Steifel works a lot with the sponsors on all those other business units. So it makes a lot of sense for us to play there. We do look at NAV deals very situationally. We have actually been getting a fair amount of inbound traffic on NAV requests. We can't do them all. If it's a sponsor we know really well and the fund's fully called, we need to lend against the assets for a bit to bridge to a realization. That's not a problem. We can look at that. Less so doing the full-blown kind of NAV deals that are part of the leverage strategy. But we can do this situationally. But other than that, really kind of maintaining this core focus on, $200 million and below sublines.
Good, good. Well, the COVID disruption has impacted many of our clients, very, very differently. How has the disruption impacted you guys?
Yeah, so, aside from the obvious disruptions that everybody's feeling, getting used to working from home and video conferencing, it hasn't been too bad. We have seen fundraising delays on a fund-by-fund basis, and certainly those are going to slow originations down on those specific deals, but it's not risen to the level of materiality where it's really affected anything large scale, at least for the fund banking side. So, we have been very thankful that it's been a bit of business as usual for us. And you never want to make light of a pandemic like this, but I think there is an optimistic view of the whole thing, and that is that the fund finance market really kind of got its stress test. That I think, a lot of us thought maybe it needed. It's definitely not over yet, but the initial shock is certainly over. And, think about how you felt back in January of this year, 10th year bull market, everything's good. And there was always kind of like a little bit of anxious underpinnings on, what's going to happen when the next crisis hits? What is it going to look like? How is the fund finance market going to be affected, or will it affect the crisis, right? I mean, there was, think about how much larger the fund finance market, and better than anybody, how much larger the market was now than it was 10 years ago during the last crisis. All of the funded equity from LPs that has otherwise been displaced from subscription borrowings. So, is that going to accelerate any kind of systemic risk? So there's all these questions that everyone was asking. And in March of this year, we got our 30% decline in 1 month. It was rough, but so far, and correct me if I'm wrong, you cover a broader swath of the market than I do, but no major LP defaults, no major credit losses, still fairly consistent routine utilization and capital calls. So, it's again, don't want to make light of something like this where a lot of people are suffering, but at the same time, for the fund finance market, we got a stress test, and so far we've come out pretty resilient.
Yeah, no, that's completely consistent with our experience. I mean, we have not been brought in to advise on any meaningful credit events, either at the single investor level or at the fund loan level. So I think it's something that our bankers deserve a lot of credit for. These transactions have been well structured. I think the funds also deserve a ton of credit. They've done a good job of managing their liquidity, as have the investors. But from an industry perspective, it's certainly a very positive credit story for sure.
Yeah, definitely.
So what about the second half? What are you guys forecasting from a market perspective?
Yeah, so it's really anyone's guess. It's hard to really speculate on the broader market. If you were to ask me that question back in March, again, when public equity was down 30% in 1 month, I would say, it's kind of scary. It's you're hearing a lot of talk about the denominator effect, how LPs are going to allocate to alternatives when their existing allocation is all of a sudden overly inflated because of public equities. But here we are talking in July, we're back up retesting all-time highs. So conversations like that have subsided a little, but could go back down, who really knows at the end of the day on the broader market. I definitely can't speculate on that, but for the fund finance market specifically, I think, I remain bullish. I think we're going to come out of this in a good spot, and we're going to continue to see growth. And again, going back to how the pandemic is, looking at it glass half full a little bit, how we got our stress test, we really proved the resilience of the market. Think about it, from a bank CCO's perspective, looking at various different portfolios, especially compared to a lot of the more COVID impacted, maybe hospitality exposed portfolios. This is still, if the trend continues where, we really don't have any major credit issues throughout this whole thing, when liquidity turns back to normal and everything, I think it's going to be a really solid asset class, which is what we've known all along, but now is really proved out. And, you might continue to see that trend of more banks getting into the space, not less. Certainly a trend that we saw in 2019 with various new participants, STIFEL being one of them. So I think there's going to be more supply kind of when the dust clears. And then, from a demand standpoint, I think the subscription line specifically has really proved its use case now more than ever. think about the GPs that, may have had to issue a painful capital call in March when LPs really didn't want to do that. And the subscription line they had allowed them to bridge them until the markets rebounded a little bit. So, I think, is that GP going to borrow more or less? Probably more going forward. It's really been, it's been a great tool, and I think it's helped the overall kind of private capital ecosystem. So I think more supply, more demand, and, pretty bullish, and think that the fund finance market's going to continue to be really strong. We'd love to hear your thoughts as well on kind of predictions going into the second half here.
Yeah, I think I share a lot of your optimism. I think I'm very, very comfortable at the moment from a credit perspective. The facility structures had held relatively stable over the last 2 years. There wasn't sort of a structural race to the bottom that now gives me concern that we've got credit risk that's heightened. So I feel really good from a credit perspective. I do think the second half of this year is likely to see some moderation in the overall deal volume compared to the first half. I mean, the first half had a really big burst of deal flow as people accelerated timelines that would have been summer closes well into the second quarter. So I think, when you combine that acceleration with some of the fundraisings taking a little bit longer now because in-person due diligence isn't possible, I do expect some moderation in the overall pace in the second half of this year. But to your point, the subscription facilities utility was really borne out here. I think the product is now firmly a staple of the industry. My guess is when you take a long horizon, we've got pretty good growth prospects going forward.
Yeah, absolutely. Thanks so much, to you and the FFA for kind of adding more transparency into this industry, which is otherwise kind of opaque, because, it helps people like me a lot communicate to upstream, how the overall market and all the participants, are we seeing any big LP defaults? This would not be something that I would be able to really know by myself, but collectively with the information compiled from the FFA and the calls you guys have been kind of hosting, it's definitely been helpful. So thanks.
Oh, that's great. That's great. Well, Mike, thanks a ton for joining us. It's good to see you, man. Yeah, absolutely. You too. Take care. So next we have with us Tess Virmani, who's the Associate General Counsel and EVP of Public Policy at the LSTA. Tess, thanks for joining us. How you doing?
Good. Nice to see you, Mike. Thank you for having me.
You bet. You bet. Well, appreciate you joining us. Hope your family and you are surviving COVID okay? We are hanging in there. Great, great. Well, you have been involved extensively in the LIBOR transition. I want to chat with you a little bit about that. At the end of June, ARC produced some updated guidance for lenders and market participants. Can you tell us a little bit about the recommendations?
Absolutely, yeah, because it's an important milestone for the market, actually. So just before turning to the language, I think it may make sense to give it a little bit of context as to where it falls in the LIBOR transition process. In the spring, the ARC had published best practice recommendations for the different cash products for a more smooth, orderly transition away from LIBOR. And in those recommendations, they recommend that loan agreements that will have maturities extending beyond the end of 2021 include hardwired fallback language in the loan agreements. And so where the market has been relying on an amendment process for basically outlining a path to agree in the future some successor rate, the hardwired fallback language actually points you to the successor rate. And so it's a different approach. It's seen as safer and more robust. And so there is a push to see market participants in the loan market really adopt hardwired fallback language. To do that, however, it was necessary for us to update that language from when it was first published in April of 2019, because we've learned so much about how SOFR is going to be implemented in the loan market. And loans are really unique. We have a lot of flexibility between intra-period prepayments. extensive trading. And so a lot had to be thought through for loans as an asset class that aren't necessarily the same issues for other cash products. And so what this update did was really bring in all of that learning and market discussion and update the language so that it is really workable for loans. And so market participants can be confident that the rates in the waterfalls really will work.
Yeah, great, great. So what's next? I mean, what are the upcoming milestones in the LIBOR transition, and what does the timeline look like?
So I think the definitely incorporation of hardwired fallback language is a big point for market participants to sort of focus on. The recommendations also set out that no new LIBOR origination should happen after the end of the first half of next year. But right now, I think focusing on the fallback language makes a lot of sense. And I think by really kind of working through that fallback language, it tells us a lot about what we might start seeing in terms of new SOFR originations, because what the waterfall tells us in the updated recommendation is the first step would be term SOFR, a forward-looking term reference rate. That would be what looks and feels the most like LIBOR, and so makes a lot of sense, particularly for legacy transactions. The small wrinkle is, of course, it doesn't exist, but that is still where market participants would like to go for fallback language. The second step of the waterfall is daily simple SOFR, which is essentially applying the daily SOFR rate every day to principal, and then the payment would be at the end of that interest period. And so that's a shift to a daily rate loan. Works very much like ABR, and I've been working with your colleague, Jeff Nagel, both on the fallback language and also on the concept credit agreements that we've been working on to sort of illustrate what this looks like. But I think understanding that in the absence of a term rate, we would be moving to a daily rate is sort of important for market participants to think about. And then also just the idea that we use simple instead of compounded SOFR in the hardwired language. Compounding, while it may be where some market participants end up, it does represent a difficult rate for loans. There are a lot of challenges to that compounding raise for loans that do have fluctuations in principal, mid-period, and whether that be trading or prepayments. And the basis between simple and compounded is so minimal. I think it's average of 0 basis points for 1 month and 2 for 3 months. So I mean, really small, that there has been a lot more gravitational pull towards simple SOFR. And so I think those are the two key things to kind of keep in mind as market participants are thinking through this and looking to first include hardwired language and then to move towards new SOFR originations.
Yep. How do you feel about the progress the banks have been making towards the transition? I mean, do you see a lot of good progress being made with the LSTA member banks?
Yeah, I think that, well, there's been a lot of manpower put to this and a lot of resources. And even despite, the COVID-19 crisis, which obviously diverted a lot of attention, I think there's been a lot of progress made. And so banks, across their institution obviously have these massive transition programs underway. If we bring it down to loans, and because there is so much that had to be worked through, I think this last 6-9 months of really working with vendors and systems providers and then lawyers, business, to really think through how this needs to be implemented for loans has put us in a really in good shape. So there's still a lot of work to be done. Obviously, we need to start seeing new SOFR loans, but I think we are on the right path.
Good. Well, I want to switch gears with you and talk a little bit about ESG. There's a really strong and very positive trend in the fund finance market trying to bring ESG standards into funds finance transactions, including a couple of transactions now that have been consummated that have ESG triggers that can lead to pricing improvement for the borrowers. The LSTA has been one of the thought leaders in this space. Can you tell us a little bit about the guidance that you all have put out around ESG standards?
A very interesting, evolving area, and one that I'm particularly interested in. And I have the pleasure of leading the sustainable finance and ESG initiatives for the LSTA. So it is an area that I spend quite a bit of time. And you're absolutely right that this is a topic that has been gaining traction. We have been seeing in the syndicated loan market a number of sustainability-linked loan transactions. We had seen green loan transactions, which are basically use of proceeds loans for green projects, start to come, and then really sustainability-linked loans, which have the availability to use for general corporate purposes, but then have the margin tied to the borrower's sustainability performance. They really can apply in a number of different industries and are a sort of important transition tool for companies and a means of banks supporting their clients in their transition process. So it's a really kind of interesting dynamic structure. We at the LSTA have joined forces with the loan trade associations around the globe, so the APLMA and LMA, to publish frameworks around green loans and sustainability-linked loans to offer sort of something of a recognizable product to make it clear what are the core components that classify a transaction as a sustainability-linked loan, because it's really important in this area that you are able to sort of rely on the integrity of the product, and that when a new structure comes to market, it can go off in different directions. And so we thought it was really important to, from an early stage, sort of offer these frameworks to the market. And they've been well adopted, and I think have been very, very helpful in also just educating market participants about these structures. And the fact that they are global, I think, is also very helpful, because you have alignment across jurisdictions. You might have investors across jurisdictions, so it's helpful that we've been able to coordinate it on a global basis. And so that's something that we have seen a lot of activity in the property development REIT space, also in general industrials. Obviously, energy is a big one, and then now even in also for financial institutions. And so it's definitely a space to watch. The loan market has also been looking at ESG from the investor side too, so away from sort of structures and designing products to support transition paths, but also just responding to the increased focus on ESG factors by investors, so by the end investors. So the asset managers in our membership have increasingly been getting calls from their end investors to be including ESG factors in their risk analysis and investment decisions, to be able to answer to them on ESG issues. They're getting more ESG questions. And the loan space, largely because it's also a private market, it's very hard to get that reliable ESG information. And so the LSTA has worked with a number of our buy-side firms, and now more broadly with other members, to develop an ESG diligence questionnaire that borrowers can complete and post to the public side of the data room for loan investors to review as they're thinking about participating in a loan transaction. And it really goes to sort of the heart of core ESG information that will assist investors in the decisions that they're making, while still sort of recognizing that many borrowers in the loan market are kind of new to this, and this is an emergent practice. And so we've tried to strike a balance between the two, but definitely we think it's important to have kind of taken a step to start this diligence hygiene and really be able to kind of spark conversation in the market, because it's a trend I do not see going away.
Right. Well, that's terrific. Are the standards themselves, are they more environmentally focused, or is there a lot of emphasis on social responsibility as well?
The questionnaire is drafted to address environmental, social, and governance factors. It is drafted, though, in a fairly open-ended way. So the idea was to allow borrowers to respond in sort of the way they are already thinking about it, so that they're not being asked to sort of reconfigure their information, their thinking to follow a certain framework, because there's still a lot of fragmentation in the market. There are different frameworks out there. There are different disclosure protocols. And so we thought it best to allow borrowers to sort of approach it in the way they are approaching it for their business. And so in that way, it's not prescriptive as to how you respond. We ask questions about the frameworks that inform your processes, about the processes themselves, who has control over them, who's monitoring it, how senior is the level of oversight, and then ask specific questions around what are the business, risk factors, environmental risk factors that you've identified, social governance. And we do point to the SASB materiality map as a point of reference. And, that is, I think, one of the resources that is seen, looked to very often in the market, but we are not prescriptive. And so borrowers are able to complete it as they wish. And we encourage borrowers to complete what they can, with the idea that they can then build towards a more fulsome completion of the questionnaire, but very much recognizing that we are starting a process and we really want to encourage participation rather than trying to have a perfect questionnaire today. That their responses will evolve and become more robust as their thinking about this becomes more advanced.
That's great. Well, Tess, you and your colleagues at the LSTA always just do a terrific job of leading and supporting the markets. And, you've been a great contributor to the fund finance side as well. So thank you, for your leadership.
Thanks very much.
You bet. We're glad to have you. Thanks for joining us.
Thank you.
So thanks for tuning in to Fund Finance Friday Industry Conversations. We'd welcome your feedback. If you have any suggestions, please reach out to me. Let us know how we can make it more productive for you. Have a great weekend.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.